In this video, we are going to break down 3 sales growth stocks smart money is buying right now during the AI shakeup, and why these companies may outperform even as the market rotates and volatility rises. You are about to learn how 3 fundamentally strong businesses with real demand, durable competitive advantages, and consistent financial performance could weather economic uncertainty and still grow your wealth over time. We are talking about companies with entrenched market positions, recurring revenue streams, strong balance sheets, and strategic drivers that could compound shareholder returns even if AI and technology continue to reshuffle the landscape. These are not speculative tech plays with no earnings or sales momentum. These are real businesses with real profits and long histories of returning value to investors. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Let's start with Genuine Parts Company, ticker symbol GPC. If you're looking for a business with deep roots, broad scale, and a history of consistent growth, GPC checks all the boxes. This is the kind of company that has been quietly compounding wealth for investors for decades without needing to make headlines every quarter. Genuine Parts Company is a global distributor of automotive and industrial replacement parts. On the surface, it might sound like a simple parts business, but it's anything but. GPC operates across 2 primary segments: the Automotive Parts Group, which most people know through the Napa brand, and the Industrial Parts Group. They sell everything from auto parts and tools to specialized industrial equipment and provide value-added services that make them indispensable to their customers. That combination of breadth, scale, and entrenched relationships is what gives GPC its competitive advantage. Think about it this way. They have thousands of distribution centers, an extensive supplier network, and long-term contracts that make it nearly impossible for a new competitor to replicate their reach. A local shop needs parts, fast, and GPC can deliver. That reliability creates a lock-in effect with their customers. On top of that, their brand recognition and decades of service history give them a trust edge. People go to Napa not just because they have a store nearby, but because they know the parts will be available, they'll fit correctly, and they'll be backed by service. From a growth perspective, Genuine Parts is quietly expanding into new markets while maintaining its core distribution dominance. The industrial parts segment continues to benefit from consistent demand across manufacturing, logistics, and service industries. Meanwhile, the automotive parts segment is riding long-term tailwinds like vehicle maintenance demand and the growth of e-commerce. GPC has been investing in logistics and digital platforms to make ordering faster, tracking more accurate, and inventory more predictable. That might sound mundane, but for a distribution company, these operational improvements compound over time into significant efficiency gains and higher margins. Now let's talk financials, because understanding the numbers is where the story becomes compelling. Genuine Parts Company generates around $24 billion in revenue on a trailing 12-month basis. That is not a startup number. This is a company operating at scale with predictable cash flows. Their revenue growth may not explode in double digits like a tech stock, but it is steady, sustainable, and resilient to economic turbulence. That stability is precisely what smart money investors love. Dividends are another crucial part of the equation. GPC has a long history of paying and increasing dividends, with yields around 2.8 to 3%. That might seem modest in isolation, but it reflects the company's discipline in returning cash to shareholders while investing in growth. Dividend increases over decades signal not just profitability, but management confidence in the long-term trajectory of the business. The beauty of a company like GPC is that it compounds quietly. Revenue and earnings growth may feel understated, but when paired with dividends that get reinvested, it becomes a snowball effect. Investors who buy into companies like this aren't chasing excitement. They're investing in predictability, resilience, and a business model that has proven it can survive multiple economic cycles. One more thing that makes GPC especially interesting in today's environment is its position relative to AI-driven market volatility. While much of the market is chasing the latest AI-related news or tech hype, GPC benefits from the simple reality that cars will continue to need parts and industrial customers will continue to need their supplies. Their growth drivers aren't dependent on being the next AI sensation or keeping up with tech trends. Instead, they are deeply grounded in essential, real-world commerce. That gives them a defensive yet growth-oriented profile that makes them attractive during market turbulence. GPC represents the first example of a stock that is durable, simple in concept, and yet extremely powerful over the long term. Its combination of distribution dominance, trusted brands, stable cash flows, and consistent dividend history makes it a perfect candidate for a growth and income strategy in a world where AI hype often overshadows businesses that quietly deliver consistent results. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our next company is Wheaton Precious Metals, ticker WPM, a company that operates differently from almost any other in the natural resources space. It is a precious metals streaming company, which means it doesn't own mines in the traditional sense. Instead, Wheaton negotiates agreements with miners to purchase a portion of the output at fixed prices and then sells it at market rates. This model gives investors exposure to gold and silver upside without the operational risk of running mines, dealing with labor disputes, or managing capital-intensive infrastructure. The brilliance of this business is in its simplicity and scalability. Wheaton effectively leverages other companies' operations while capturing a predictable, highly profitable slice of production. What makes Wheaton especially attractive right now is that its revenue and earnings growth are accelerating. In recent quarters, the company has reported record revenue and substantial earnings increases, driven by higher metal prices and increased production from existing streams. Its growth is not just tied to commodity prices. It comes from a steadily expanding pipeline of new agreements and streams with high-quality mines. Each new contract adds incremental revenue with minimal incremental capital outlay. That is rare in the mining space where expansion is typically expensive, risky, and slow. Wheaton's business model gives it a durable advantage. Traditional miners have to contend with volatile costs, declining ore grades, and massive capital requirements to expand. Wheaton sidesteps these challenges. By acquiring streams up front, it secures a long-term entitlement to production at low cost while leaving the operational headaches to its partners. This creates a financial moat that is extremely difficult to replicate, especially for investors seeking exposure to precious metals in a lower-risk, high-leverage way. The numbers illustrate why this is a compelling story. Revenue in recent quarters has surged, with one quarter showing a year-over-year increase of nearly 68%. Adjusted earnings almost doubled in that same period. Cash flow from operations remains robust, and the balance sheet is strong, giving Wheaton flexibility to pursue additional streams and make strategic investments. The company has also increased its dividend, signaling confidence in its ability to generate sustainable, predictable cash flow. For an investor, that combination of growth, financial strength, and cash return is powerful. Beyond the numbers, Wheaton stands out for the quality of the underlying assets it partners with. Many of its streams come from long-lived, high-grade mines with reliable production histories. That means the revenue it receives is both predictable and resilient. Commodity prices may fluctuate, but a well-structured streaming agreement ensures that Wheaton's cash flow is cushioned against short-term swings. This predictability has drawn the attention of professional investors who increasingly view WPM as a way to hedge against uncertainty in other parts of their portfolio while still capturing growth potential. Another factor driving growth is the increasing global demand for precious metals. Gold and silver are not only investment assets but also industrially relevant. Electronics, solar panels, medical devices, and even emerging clean energy technologies require these metals. That adds another layer of structural demand that supports Wheaton's long-term relevance. Unlike companies dependent on fads or cyclical technology trends, WPM is anchored in assets with multi-decade demand trajectories. Investing in Wheaton right now means participating in that structural growth while benefiting from a model that converts raw commodity exposure into high-quality, low-risk cash flows. The company has demonstrated that it can deliver growth in earnings and dividends without the typical volatility of mining operations. That is why smart money investors are increasingly attracted to WPM during periods of market uncertainty. While other investors chase AI hype or short-term growth stories, Wheaton offers a combination of growth, stability, and compounding potential that is rare in today's market. It is also worth noting that the company's strategic focus is long-term. Management prioritizes high-quality deals that enhance revenue predictability and reduce operational risk. That disciplined approach means that even as markets fluctuate, the underlying business continues to grow steadily. For an investor looking for exposure to natural resources without the typical volatility, WPM delivers a unique and compelling proposition. When you combine all these factors, structural demand for precious metals, a capital-efficient business model, strong growth in revenue and earnings, predictable cash flow, and a rising dividend, Wheaton Precious Metals becomes an ideal candidate for investors seeking both growth and stability. It is a reminder that not every opportunity requires chasing the latest market fad. Sometimes the most powerful investments are companies quietly compounding value while the rest of the market focuses on the headlines. The third company on our list is First Energy, ticker FE, a different kind of growth story, one grounded in stability and long-term reliability. This is a company that delivers electricity to roughly 6 million customers across multiple states in the U.S., providing generation, transmission, and distribution services. On the surface, it might seem like a classic utility, and it is, but the value lies in what utilities like FirstEnergy offer investors: predictable cash flows, strong dividends, and regulated growth that is relatively insulated from the short-term market frenzy that affects other sectors. FirstEnergy's competitive advantage is rooted in regulation and infrastructure. Utilities operate under state-level regulatory frameworks that allow them to earn a predictable rate of return on capital investments, such as new transmission lines, grid upgrades, and generation assets. That predictability turns capital expenditure into a growth engine. As FE invests in expanding and modernizing its grid, it effectively increases the value of its rate base. That translates to higher future revenues and earnings, all while serving a customer base that depends on electricity every day, no matter the economic environment. The company's growth is also supported by structural trends in energy demand. Commercial demand is rising with the expansion of data centers, cloud computing, and digital infrastructure. Residential demand remains steady, driven by population growth, electrification trends, and the transition toward cleaner energy sources. All of these factors contribute to a stable, long-term revenue base for FirstEnergy. Unlike many high-growth tech stocks that face uncertainty in market adoption or competition, FE's growth is tangible, grounded in physical infrastructure that people need and will continue to rely on. Financially, FirstEnergy generates roughly $13 to $14 billion in annual revenue, with recent quarters showing modest year-over-year gains. Net income and operating cash flow remain solid, reflecting the stability of its business model. The company also offers a dividend yield in the range of 3.7 to 3.8%, one of the higher yields among large U.S. utilities, which makes it attractive for income-seeking investors. Steady dividends, combined with regulated growth, create a predictable total return profile that many investors value in turbulent markets. Another reason FE is compelling in today's investment environment is the emphasis on infrastructure modernization and energy transition. Utilities that invest strategically in grid reliability, transmission efficiency, and modernization projects are well positioned to benefit from regulatory support, favorable rate cases, and growing demand. FirstEnergy has a portfolio of such investments, which adds to the long-term stability and potential for incremental earnings growth. It is easy to overlook utility stocks because they do not make headlines like AI stocks or the latest technology disruptors. However, FirstEnergy is a textbook example of a cash-generating company with a moat, predictable growth, and the ability to weather market volatility. During periods when other sectors face uncertainty or rapid swings in investor sentiment, a utility like FE provides a ballast in a portfolio, delivering both safety and modest compounding growth. When we look across these three companies, Genuine Parts Company, Wheaton Precious Metals, and FirstEnergy, we see a common theme. Each operates in a space where scale, expertise, or structural advantage creates a durable competitive position. Each converts its unique business model into consistent revenue and cash flow, and each offers investors a way to participate in growth without taking on speculative risk tied to short-term market fads. Genuine Parts Company compounds through operational excellence and customer loyalty. Wheaton leverages its streaming model to capture metals upside efficiently, and FirstEnergy uses regulated infrastructure investments to generate stable returns. They are not glamorous in the sense of flashy tech stocks, but their strength is in reliability, predictability, and long-term growth potential. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now I want you to think about this. When you compare these three businesses, which do you believe has the most sustainable advantage over the next decade? Is it the operational dominance of Genuine Parts, the leveraged but low-risk commodity exposure of Wheaton, or the predictable regulated growth of FirstEnergy? Consider how each business earns its returns, and how resilient those earnings might be during economic turbulence. Share your thoughts in the comments below. I would love to hear your perspective on which of these approaches you think has the most enduring edge. All three stocks highlight a key principle that smart investors follow: focus on companies with strong underlying economics, durable moats, and predictable growth trajectories. The market will always have its trends, hype cycles, and volatility. AI is exciting, crypto is exciting, and emerging tech may deliver high growth, but it also comes with uncertainty. Companies like GPC, WPM, and FE show us that there is immense value in choosing businesses with predictable compounding performance over the long run. Investing in these kinds of stocks requires patience, discipline, and a focus on the fundamentals. By understanding what drives revenue, cash flow, and dividends, and by assessing the durability of the competitive advantage, investors can make smarter decisions that are less influenced by daily market noise. These three stocks provide a blueprint for combining steady income with long-term growth potential. They illustrate how professional investors allocate capital in a way that balances risk with growth opportunity, and how retail investors can follow that logic to build wealth over time. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.